In this video, we're going to talk about Vinco Ventures, trading under the ticker symbol BBIG. At the moment, there's a lot of volatilities coming out of the financial market, and not all of them are good. So we have to be careful about which stocks to pick, which stocks to dump, and which stocks to watch after. This video will cover the recent price actions and the technicals of BBIG. Before today's video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to around $2.70 before closing the trading day at $2.68. We should definitely pay attention to the $2.66 nearby because it was tested 4 times before, making it a significant support level to watch for. Over the past 30 days, the trend of the stock has been bullish because despite the recent sell-off, the stock is still above the support trend line around $2.25 from where the uptrend initially began in 2022. Of course, it's now really testing the limit of that uptrend, so we have to watch closely whether the trend can hold itself or if the stock is going to reverse the current tendencies. From the perspective of a longer time frame though, 6 months and above, the trend of the stock has been bearish because the stock has been under a huge amount of selling pressure from institutional investors. This has been going on for the better part of a year at least, and the selling pressure is not going to decrease now that it may see its uptrend reversed. When we look at the price trend overall, it has been slowing on the bullish recovery, which was already weak in the grand scheme of things. The stock is under the pressure of short sellers and the reluctance of investors to invest in speculative ventures in this current period of time. The trading volume of Vinco Ventures has recently been 20 million shares versus the average volume of 33 million shares. Over the previous 52-week period, its price fluctuated between $1.95 and $12.49. The market cap of Vinco Ventures is currently at $367 million versus the enterprise value of $362 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the assets value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient for many other companies. One key element to note regarding the enterprise value is that for growth-type companies, one of the most significant assets they may own is called goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to have more growth than other companies, partially because it may have a good management team, a stronger brand recognition, and bigger online following. It is basically what makes a company unique versus its rivals. In other words, it's not a tangible asset that companies can use, but it's often the reason some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and because the enterprise value is also less reactive to the market cap in very volatile situations. However, if the company goes to liquidation, the goodwill would be completely gone, and we would be left with potentially less assets to distribute to shareholders and debt holders than the number on the balance sheet. When we compare the current price to its historical price fluctuations, the stock is 6% higher than the 1-month low, 25% higher than the 3-month low, and 40% higher than the 52-week low. On the options market, which gives a hint about the market sentiment about the stock, the implied volatility is 140% versus a historical volatility of 180%. The put-call volume ratio is currently at 0.13. It's normal for most stocks to also tend to have a higher put option volume than what they deserve because many institutional buyers systematically hedge their long positions by buying put options. The most recent volume of options traded has been 76,000 contracts in a day, versus the 30-day average of 121,000. In terms of open interest, the most recent volume has been 857,000 contracts versus the 30-day average of 857,000 contracts. Regarding the shareholder structure, institutional buyers have about 13% of the company, and the biggest ones are Nomura, Vanguard, and BlackRock. It's relevant to understand the composition of the company's shareholders because it helps to determine whether you should be holding the stock long-term or to simply view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is between 25 to 30% of institutional participation for the stock to be perceived as a sound investment. Obviously, a lot of exceptions would apply since many great companies are also held by retail investors and not institutional ones. But so far, this is the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, it can be a sign that there is an organized shorting operation going on, like what is going on with GameStop and AMC. The current short interest is 31% of the total float, which is very significant and given arguments to whether there is an organized shorting from institutionals going on, and 52% of it coming from the dark pool transactions. Overall, my opinion on Vinco Ventures is to remain on the sideways because I would prefer to wait and see where the stock is going to go and whether there will be support lines to appear before committing capital in the company. It's very close to a value region, so I would follow up to it very closely and see if it can keep the uptrend that has started since January of this year. The maximum exposure I would recommend is 1% of the portfolio. For the immediate term, my recommendation is to wait for better timing because we have to see some confirmations that the support levels have been reached and will be able to hold there going further. I would recommend to separate the allocation in batches of 20% at a time so that you can have enough room to buy later should the price correct once again. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks when shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.